Okay, this is the more advanced investing video of the two videos. So let's jump in. Um, okay, so what we utilize is what's called a core and satellite strategy. Okay, it's a core and satellite strategy. All that means is you have one core position that probably won't change very often. Now that's going to be made up of big American companies. Okay, so I mean I can tell you, so let's say you took $100,000 and put it into the core position. You'd be looking at, you're putting in $5,800 into Apple out of the 100,000, 5,500 into Microsoft, 4,200 into Amazon, 4,000 into Google, 2,200 into Facebook, 1,400 to Berkshire Hathaway, 1,300 into Tesla, 1,200 into Johnson and Johnson, 1,100 into Visa, 900 into Home Depot, etc., etc. So the core position is going to have big American companies that you've heard of. They're called large cap, large companies, large American companies. So that would be your core position. Now, around that core position, there are going to be satellite positions. Now, those aren't going to always be the same. We're going to be changing the satellite positions from time to time. Now, there are 11 sectors in the American economy, and those are the satellite positions. So the 11 sectors in the US economy would be healthcare, materials, real estate, consumer staples, consumer discretionary, utilities, industrials, energy, consumer services, financials, technology. Those are the 11 sectors. There's also medium-sized companies, which would be called mid-cap companies, mid-cap stocks. There's also small companies, which would be small cap or small cap stocks. There's international stocks where you're investing overseas. I don't really invest too much overseas. I'm kind of a patriot when it comes to this. So almost all the money that we're investing is in US-based companies. And there's just a little bit of money in emerging markets. Now, emerging markets would be economies that are basically third world countries, but they're kind of developing into developed nations. So there's a little bit in these emerging markets. So when it comes to the satellite positions and these key sectors in the U.S. economy, what we are doing is something called value investing. Now, what value investing is very simply, we are looking for things that are out of favor. We are looking for sectors that are temporarily down, and we want to put our money into that. We want that to be a satellite position inside the portfolio. And I know that might sound kind of, I don't know, counterintuitive, but that's, you want to buy low, right? I mean, that's a basic investing strategy. So again, there would be the core position, which isn't going to change all that much. You're going to have the satellite positions around it, which is going to be made up of all these sectors and different kinds of different sizes of companies. And really what we're trying to do here is smooth out the ride. In addition to trying to maximize returns, we want the volatility to be as low as possible. So by using these kinds of strategies where we're utilizing different sectors and different kinds of companies at different times, not only are we trying to maximize returns, but anyone, all of you, want the volatility to be as low as possible. Obviously, it's never going to be zero. There's only so much you can do, but there's definitely some ways to smooth out that ride, smooth out the ups and downs. So that is the stock bucket. That is the stock portion of this investment strategy. Now, beyond that, there's the bond bucket. There's the bond portion of your portfolio, because of course we don't have all of the money in the stock market. Some of it is in the bond market. There's three basic kinds of bonds. There are government bonds, there are municipal bonds, and there are corporate bonds. Now, government bonds would be you're loaning money to, the federal government, to a government agency. Municipal bonds are where you're investing into a municipality. Let's say a municipality is building a new bridge. They would ask for money from the public. You're the bank. We talked about this before. You're loaning the money to the municipality, and now with municipal bonds, the one attribute that is really attractive to people is the fact that municipal bonds, the interest that they pay is tax-free, which sounds very appealing, very attractive. But there's a problem to this, because generally when you're retired, you're in a lower tax bracket than when you're working. And municipal bonds pay a significantly less interest rate than similar bonds, like similar corporate and government bonds, because municipal bonds, because they're tax free, they understand that they're able to pay significantly less interest because the people that are using them are people that are trying to get tax free income. So unless you're making hundreds of thousands of dollars, generally municipal bonds don't make all that much sense, and I do not use a tremendous amount of municipal bonds inside my portfolios. Corporate bonds is you're loaning money to a corporation. Home Depot is building a new building and they need money for it, and you loan them the money and they give you an interest rate and they pay you back at the end of the term. Now, the philosophy behind the bond portion of this portfolio, I feel very strongly about because I see a lot of people making the same mistake when they design their portfolios. Now, there are different ratings when it comes to portfolios. You could put money, or when it comes to bonds, you could put money in a AAA rated bond, in a AA rated bond, in an A rated bond. And what that means is the AAA rated bond would be as safe as can be. Generally, that would be U.S. government bonds. People from all over the world invest their money in U.S. government bonds because they're the safest instrument there can be. I mean, obviously, you can't guarantee it, but there's no safer place to put your money. AAA. And because they're AAA, it's possible to, the interest rate they pay is a lot lower because, right, risk equals reward. So AAA, very low interest, risk equals reward, very safe. Now AA, still very safe, very, very little risk of anything defaulting. And even if something does default, you have hundreds and hundreds of other bonds that are working for you. So AA is not much, still very, very safe, and A is still very safe. So what I say to people and what I see is people are too conservative in their bond portfolio. People put all of their money in AAA bonds and get almost no interest. And my argument would be, well, let's just go down the ladder just a little bit, still very safe, and eke out more interest. Risk equals reward. So you can invest in bonds that are little, like I said, down the ladder, and we can eke out a couple percentage points just by increasing the yield by going down the ladder a little bit on your bonds. So I feel very strongly about this. We want to maximize the return, maximize the income that we have coming out of these bonds, and that is how we do that. Okay, now the investments themselves, we're utilizing a vehicle called an ETF. That stands for Exchange Traded Fund. An exchange traded fund is just like a mutual fund. It's one fund and it has lots and lots of companies in that one fund. And the only difference between an exchange traded fund and a mutual fund is that mutual funds, you can only trade them at the end of the trading day. And these exchange traded funds are just like stocks. You can change them any time of the day. There's no limit to that. So now, whenever you're dealing with an exchange traded fund or a mutual fund, there is an expense embedded in that fund. So the mutual fund manager or the exchange traded fund manager, in exchange for putting these things together, they're going to charge you money for that. Now, you know, a lot of these are maybe 1% or 2%, but I am ultra neurotic about keeping the expenses as low as possible. So we use incredibly low expense ratios for our portfolios. I utilize a company called Vanguard, which is the most well-respected. It's not all Vanguard, but I use a lot of Vanguard funds because their ETFs are incredible. Their expense ratios are so low. The average expense ratio that we're dealing with here is about 0.05%. I mean, that is like 20 or 30 times less than some other funds. So again, I'm extremely neurotic. We keep ultra low cost ETFs. We use a core of big American companies. We have satellites around that. We're using a bond strategy where we're going down the quality just a little bit and getting a better return. Using Vanguard, ETFs. I think that's a good a review. I don't think there's anything else I need to say. If you have questions, obviously let me know. Give me a call, and I hope that helped.